Just one candle is all you need to learn how to identify accumulation and your bias in which direction the market might move. Interesting, right? Don't forget to like, and I'll begin. Today, we'll talk about CRT. As you understand, all we need is just one large bullish or CRT candle. On which time frame should you look for it? Since the market is fractal, this will work on absolutely any time frame. But based on my experience, I'll say this. It works most often on higher time frames. And is there any point in going down only to the 1 hour time frame? Lower than that, the ranges become too small. But for a clearer analysis, it's better to drop down to the hourly time frame. Now, let's break down a bullish candle and see how it should form, and how this will later influence the price reaching the upper and lower zones of that candle. We'll also touch a bit on structure and why you're trading it wrong. First, let's analyze the euro-dollar pair. On the weekly time frame, we need to find this large bullish candle. It was quite large and also swept liquidity on the left side of the chart. But honestly, that's not even necessary because, as you understand, we'll be working within the range of this candle. We can easily push to take out this high and then drop to take out this low. And when we eventually target this candle's range, we might just grab that leftover liquidity sitting here on the left. So that's not a mandatory factor. We only need to find a large bullish candle. Next, we need to look at what's inside this big candle. This is the weekly time frame. Let's mark this as our potential future range, the one we're analyzing. And then we'll break down the structure inside this candle. On the daily time frame, we can see an imbalance on the buy side here, and there's another imbalance over here as well. And by the way, you may notice that once again, we have a large bullish daily candle. The previous high was taken out, and now we'll likely head down to test this low. A small range is also forming here, but that's not directly related to our weekly analysis yet. At this point, we've essentially identified inefficiency, and now we can move to a lower time frame. Since we're near the high of this weekly candle, the most likely scenario is that we'll push to take out this high first. So the broader context is potentially bullish, but because this weekly candle was extremely strong, creating significant inefficiencies on the buy side, we'll likely see a correction toward the 0.5 zone. Therefore, for the current new week, this low will act as liquidity that we might target, sweeping it first before considering any long positions. In the end, this week we saw the price drop into this imbalance located around the 0.5 zone, or even below, into the discount area. From this zone, we could have considered long positions, as there's an imbalance here and a clear order block, a major one, likely on the daily or even weekly time frame. Now, let me briefly touch on structure. Someday, I'll finally make a dedicated video about this, but here's the thing. Traders who rely solely on structure as the primary factor for determining bias are no different from those trading support and resistance. Why? Because structure can be drawn in any way the market wants. Right now, we see a high, a low, another high, then another low, followed by another high. Logically, price could reach this order block, react there, and then continue lower, because the overall structure hasn't shifted yet. So what do most traders do in this scenario? They open short positions, placing their stop losses above this high, or that one, or even somewhere across this entire zone. But here's the problem. By doing so, they're essentially giving the market a clear liquidity target. Big players know retail traders cluster stops there, so price will often spike into those levels, trigger the stops, and then reverse. That's why blindly trading structure, without considering liquidity, imbalances, and higher time frame contexts, is just as flawed as trading basic SR. The market hunts predictability. But remember, market structure is formed purely by liquidity. Right now, you might think, this should be the high, but the market can easily paint a fake high like this, making you believe the trend has broken. Structure can always be violated, and trends can reverse unexpectedly. However, traders who truly understand how structure forms, and more importantly, how liquidity drives it, will see that price has already swept the liquidity from this high. That means we should actually be looking for short opportunities here. Yes, I agree, we're near a major high. But don't forget, we're inside a massive weekly range. And what does price do in a range? It accumulates longs or shorts. Earlier, I mentioned that this is a short accumulation zone, because there's a ton of liquidity sitting below, right here. We've already swept the major liquidity on the left side of the chart, so my expectation is that price will continue lower, grabbing liquidity from here and here. There's also a cluster of equal lows in this zone, a 4-hour imbalance, but these are just liquidity traps. So what actually happened? When everyone thought structure was breaking, where did they place their trades? They likely opened positions below this liquidity, somewhere in the discount zone, hoping for a bounce. But in reality, that liquidity is exactly what price will target before continuing down to sweep the bigger pools. So what did the chart ultimately show us? Price dropped all the way to this low, and those trading smart money concepts incorrectly or relying on support resistance will get wiped out here. Understand this. In such ranges, price couldn't care less about your structure. It follows liquidity, and liquidity, as I've said before, is what truly matters. Within this range, inside this large bullish candle, price will form accumulation, and we can only trade this accumulation after price reaches a major liquidity pool, either this high or this low. Whichever side we reach first will likely hint at whether we'll break higher or lower. But again, since I've mentioned that short positions are being accumulated here, I assumed we'd somehow need to reach this high first. My decision to enter trades or not will only come after price actually sweeps the key liquidity. This brings us back to structure. Don't trade it as your primary factor. Don't base your decisions on it. Because once again, people will say, well, maybe you misread it again. But the market doesn't care about structure. It cares about liquidity. Until you understand this, you'll keep getting faked out. Price will violate any structure to hunt liquidity, and those trading based solely on structure will keep getting stopped out. The key is to watch where the liquidity sits. Those are the real levels that matter. Everything else is just noise that the market will use to trap traders. That's why you see these fake breakouts and sudden reversals. It's all about taking out stops before moving in the real direction. Focus on liquidity, not structure, and you'll start seeing the market differently. But what I'm saying is that market structure is something we analyze after the fact. It can be drawn in any way possible. So we need to focus on liquidity. Now look, if we reach the high of this range, according to this theory, we should also reach the low of this range. Moreover, observe how price moved toward this liquidity. It approached while forming liquidity at the low, then another low. And at the moment when price was hovering here again, well, probably everyone believed in longs, because after liquidity is taken, price should, in theory, target the removal of this high. And right at that moment, in this zone, we had a 4-hour imbalance, inversion, and it was precisely within this 4-hour imbalance, which wasn't just an imbalance but also an order block, that I made my decisions to enter the trade. Accordingly, in such cases, we always place our stop loss beyond the manipulation that has already occurred. I understand that sometimes price may retest and take out this liquidity again before moving lower, but in this case, I didn't see any liquidity left that would justify a further drop. If there had been slightly more candles here, forming something like, another high of this kind. And accordingly, I made the decision to enter the position because I like this situation's potential. The first targets that may come into play are this liquidity here, and the main liquidity located at the low of the large weekly bullish candle. And those people who went long here because they saw an uptrend, a structure breakout, they all got wiped out because the market doesn't work that way. Market structure is formed by liquidity, so study liquidity, and if you know where it is, if you trade it correctly, you won't end up being that very liquidity that got trapped many times in this range. And in the end, as you can see here, everyone got taken out on the news. And just so you can be sure that big capital was accumulating chart-based positions here, we can take this small indicator. We can roughly understand that big capital was indeed accumulating its major chart-based position near the high of this week, the main target. After it wiped out everyone who placed stops above 100 plus, taking out all participants who set their stops there, it moved toward the low, that is, this weekly candle. At any moment when you see a situation like this, they can paint a real high somewhere around here, a real low somewhere around there. And in hindsight, it's easy to say, this was the real high, this was the real low, this was the high low. You can only determine this in hindsight if you don't know how to identify highs where liquidity is present. This theory can guide you on which zones to watch, and after which liquidity zones are swept, you should then consider long or short positions.